Hi, this is Brian from KineticTrader.com, and I thought I'd just talk about some of the basics on weekly options. It seems like that's become pretty popular, and I had some inquiries about it on my site when I wrote a couple of posts just summarizing some things on weekly options, and maybe I'll do some further videos on strategies. But essentially, weekly options, for those that are new to options, generally options used to be issued for once a month expiration, but now with weeklies, they introduce them every Thursday morning for the following Friday expiration, so you can take advantage of expiration Friday every week now. A lot of the strategies that were done with monthly options are now being carried over to weekly options, so people can do say put credit spreads where they sell a put and buy a farther out of the money put, and hopefully take advantage on the credit that they receive from selling that spread with rapid time decay. The opposite is doing a call credit spread. There's people that do just simple covered call writing and are long a stock and just want to generate some income on those long stock positions by selling weekly options call options against it. There's people that take advantage of doing callers where they're doing that covered call writing and say they're long a stock and they can sell a call against it each week, and then maybe have a longer term out of the money or slightly in the money put to protect a downside, so they feel like they can generate a good enough return on a weekly basis with that covered call and be protected on the downside with that put, and that's a collar trade. People do ratio spreads where you kind of sell more options than you buy, and hopefully it stays in a certain range. People do pinning trades on expiration day where they follow the volume of the open interest on calls and options, and if it looks like it's going to pin at a certain specific strike price, they might sell options on both ends or on a certain direction, or they'll do a near the money put or call spread and benefit from the rapid time decay there and close it out on the day that they initiated the trade. And so you can see there's a lot of different variables and strategies people can do with weekly options, but the biggest benefit is that if you're focused on collecting income or time decay on selling premium with options, the benefit obviously with weeklies is you're playing expiration week every week, and so you're seeing rapid time decay and quick return on your money if you position correctly on which way the direction of the stock's going to move. It also makes great for people that want to do adjustments on a position. They can take advantage of making adjustments on a week-by-week basis. On time decay, usually what's been measured is the most rapid time decay on weekly options happens over the weekend prior to expiration. So again, options are issued on Thursday morning, and people might take advantage of having their position entered into by Friday afternoon's close and hopefully see some time decay over the weekend. For the open on Monday, they'll see that decrease in premium. Also, people have seen faster time decay on the evening before expiration day, so they might make sure that they're positioned in a trade that they want to have some time premium to decay going into expiration day, so they'll initiate that trade on Thursday prior to the close. One thing to keep in mind though is that you are exposed, oops, that was the closing bell. You are exposed to volatility on options, especially with weeklies where you're dealing a lot with closer to the money strike prices. So you are exposed to, if you see a rapid increase in volatility from an earnings announcement or some type of event that really moves the market, you can see the options that you had sold see a quick increase in premium. So you are exposed to volatility, and that is something to keep in mind with weekly options. Some people take advantage of volatility too. If there is high volatility just from an event on a certain stock and they think that it's going to decrease, say post earnings announcement, and someone feels comfortable being long the stock, they could take advantage of selling high premium puts, because if there's fear in the position, maybe it's sold off after earnings, then they could sell that premium and see a rapid decrease in premium, and therefore benefit on selling puts post earnings. And so that's something to keep in mind too, is on options with weeklies you can see a lot of change in premiums based on where the volatility is at. So those are some quick summaries. Hope that helped. I'll try and do some more videos, and you can check out my site if you have any questions. Thanks.